Hey guys, welcome to another video. In today's video I'm going to share with you this trading strategy that was used by this Hungarian trader that got him over $2,010,000 in just 18 months. Plus the modern version of the strategy. And you might be wondering that this strategy would be a very advanced or complicated strategy, but it isn't. In fact, before turning just $10,000 into $2 million, this trader developed the strategy during his off hours as a dancer because he had read over 200 books on market and on speculators, sometimes reading up to 8 hours a day. What makes this strategy even better is that the strategy uses strict trading rules to make it easy to know when to enter a position. The trader that we are talking about is Nicholas Darvas, a professional dancer and self-taught investor who became famous for his successful trading strategies that he talked about in his book. It was recorded that he began his studies by reading books like The ABC of Investing by R.C. Effinger, The Stock Market by Dyson Ironman, and The Securities Market and How It Works by B.E. Schultz. To help us in creating high-quality content like this, please click the like button, subscribe, and turn on the notification bell to get notified when we upload a new video. Now, let's get started. Let's first take a look at this particular strategy Darvas used to make millions from trading the stock market. Darvas used this strategy mainly on the weekly time frames, but the strategy has been found to work on all time frames, like nearly all trading strategies. The strategy used by Darvas worked highly well on a market that is trending up instead of when the market is going down, and it mainly consisted of buying low and selling high. As the man only traded long positions only. This strategy can be used to trade nearly any financial market. He traded the stock market, since markets such as crypto did not exist when Darvas started trading. Now let's look at the chart example presented in the book, in which Nicholas Darvas traded and applied his bulk strategy here. We can see the company Lorillard, and although it presented on a weekly chart, Darvas, the strategy can be used on any time frame. Darvas learned that Lorillard had been selling huge quantities of Kent and old cigarettes. Cigarettes were a high-growth industry at the time, and Lorillard stock reflected this with high demand seen here at point A with a spike in volume. Here Darvas recognized that a box had formed and price broke through the upper part seen here at point B, accompanied by high volume at this moment when he purchased 200 shares at a price of $27.50 each. Of the $5,500, he also placed a stop order at the price of $26 at point C. This gave a stop loss of 5.45%, equivalent to $300 against the price eventually dropped below the high of the previous box and hit the stop loss for a loss of $300. The price ended the week with the close above the box again on high volume. Darvas then re-entered the position here at point D with 200 shares at a price of just under $29. The stop loss was at this time placed in the same position with a potential loss of $400. Further purchases were made here at points E and F before finally selling at $57 for calculation purposes. We only include the box breakout purchase at point D, giving a near 100% profit of $5,500 in 6 months from a trade risk of $400. This gave a risk to reward ratio of 14-1. The key takeaway here is that by concentrating on the risk management, you create the conditions for greater rewards. Let's now touch on Darvas's box formation and criteria Darvas uses. The first point to make is that the initial stage of the box must be formed by a new 52-week high. This would represent the top of the box, and if the price retreats, the 52-week high would be classified as resistance. The point at which the price retreats and recovers is called support. This process repeats until we see a box formation made up of numerous support and resistance points. Once an obvious box formation occurs, Darvas says to set a buy order of a few points above the resistance line. Therefore, if price broke out of the box, your trade would automatically trigger without the need to constantly check price simultaneously. A sell order should also be placed within the box. This will instantly define the level of risk you are willing to take, sometimes 5%. However, We must also consider that when Darvis was trading, there were no such things as live charts or advanced indicators. We are currently surrounded with a lot more indicators and techniques at our disposal. So let me show you an improved modern version of Darvis's box trading strategy that has a higher win rate when used in the current markets. In this strategy, we will use 3 indicators, and we will also have a fixed set of rules heavily based on the Darvis box strategy. Now let's head on over to the tradingview.com to add these indicators to the chart. The first indicator that we will be adding to the chart is the Darvis box indicator. Navigate to the indicator search tab and search for the Darvis box indicator and select this indicator made by the TradingView user and add it to the chart. Now go to the setting of the indicator and change some settings, and on this input section you check this box price level, but in case we are going to leave it unchecked, then on the style tab you are going to leave everything to their default setting. Now this indicator seeks to help traders find the Darvis box because the Darvis box sometimes serves as the box for price accumulation. When the price breaks above the box to the upside direction, you will take a long trade, or when the price breaks below the box, you will take a short trade. Now let's add the second indicator to the chart, so go to the indicators tab again and search for the Wada Ata explosion indicator and click on this one that was created by Shanam KM. Now let's go to the setting of the indicator and modify some of the settings. So in this input section, you are going to change the sensitivity to 100, the fast EMA length to 15, and the standard deviation multiplier to 5. Then go to the style section and change the color of this explosion line to white and increase the thickness. Change this dead zone line from cross to line and increase the brightness of the color to make it more visible, and then click OK. Now this indicator has 4 parts. The dead zone line, which is used as a filter for weak signals. Do not trade when the red or green histogram is below it. The red histogram, which shows that the price is currently in a downtrend. The green histogram, which also shows that the price is currently in an uptrend. And finally, the explosion line, which shows the spikes in price up or down. Now, for you to enter a long trade, the green histogram must be increasing in size and above the explosion line. The explosion line must also be spiking upwards with both the green and the green histogram, and the explosion line above the dead zone line. And then you look to exit the trade when the green histogram closes below the explosion line. The exact opposite happens for a short trade. Now this Wada Ata indicator is used to track the trend, direction and strength by measuring the volume of the market participants. And when we use the indicator to track the spikes in the volume, which Nicholas Darvis stated in his box strategy. Now let's add the third indicator of the modern day Darvis box strategy, right? So what we are going to do now is go over to the indicators tab again and search for the Mavalim W indicator and add this one created by Kevin Ozabilik. Now navigate to the setting of the indicator, and on this input section you are going to change this fast moving average length to 2 and the slow moving average length to 3. Then the style section has no significant settings to change and click OK. Now this indicator uses the smooth weighted moving average combinations for various Fibonacci numbers and is a great support and resistance for long-term trading and confirmation, but in this strategy we are going to use it to track the trend direction of the prevailing asset and act accordingly as directed by Nicholas Darvis. Now here on the chart you can see that when the price made this higher high, we saw a spike in the volume from the Wada Ata indicator, and the Darvis box indicator had this box drawn in. We can take this high at the 52-week high of the Darvis box strategy. Then when the price breaks above the box from this candle, you can see that this green histogram is above the dead zone line and the explosion line, which would have another confirmation of the up move. Again, notice that the price is above the Maliv W indicator. Now that you have all your entry confirmation met at this point, you will place a long trade at the close of this candle and set your stop loss just inside the Darvis box and extend your profit target to a risk to reward ratio. Now, To help us in creating high quality content like this, please click the like button, subscribe, and turn on the notification bell to get notified when we upload a new video. Thanks for watching.